Everybody. Welcome to the second webinar, Ranmore Fund Management. Sean Pesh here, and today I'm going to talk about the problems with passive value funds. Now, this is meant to be educational. It is not advice. Do your own work, please, and read the disclaimers at the end of the presentation. I'm absolutely convinced you are going to learn something today. And if you've got any questions, email clientservices@ranmorefunds.com. Let's say you've recognized that the world is completely upside down. In the last 2 years, the world has turned upside down. We've gone from low inflation to high inflation, low interest rates to rising interest rates, offshoring to onshoring, and stability to instability. And rising interest rates, onshoring, and instability conspire to cause more high inflation. Okay, and you've watched yourself get poorer this year, as the winning funds in the old environment in which you invested your money lost you money. But you also watched Ranmore's YouTube video, is now the time to be a value investor? And you've decided that yes, it always is. Who doesn't want to bargain? So now the choice is active value or passive value. Right, well, I don't want to spend too long on what is a passive fund. I'm going to assume that most of you know what a passive fund is. If you don't, just pause and read through this here. But I certainly don't want you guys losing interest before we get to the juicy part of the presentation. So how are passive funds compiled? Well, they use indices. Okay, you saw their FTSE 100. It's all important. Is the index. Okay, so we need to look at how the underlying indices are compiled. Well, what you want to do is go to Google and type in whatever index, and then and the methodology, and then you'll find some long documents with some complicated mathematical formulas, and you can delve in there. I've tried to simplify it. And so what I've done is I've looked at 3 index providers, and for the value metric, this is what they use. So one of the index providers uses book to price, which is just the inverse of price to book. It uses the forward earnings multiple, price earnings multiple, and the dividend yield, which is historic. The second index provider only uses book to price. The third index provider uses book to price, earnings to price, and sales to price. Those are historic. So slight differences as to what variables are being used. Well, what about the growth factors? Okay, the one common thing is the book to price. And as I said, it's just the inverse of the price to book. Well, the growth factors, there are a number of growth factors. So each of them use a number of them. And you can see here growth rate forecast. This is one of the common themes. It's the forecast. And we know how inaccurate forecasts are. And so then what they do, these index providers, is you have your index, let's say the S&P 500 or the Russell 1000, and they then rank all the companies in that index according to these style factors, and they split them into value and to growth. Okay, the problem is it's not so clear cut, because as you saw, there are a number of factors. So one company might score well on one factor but not so well on the other factor, and does that make a bigger difference if there's another company which scores better on the other factor, etc. And so actually what you end up with is a quadrant, and let's explain this here. So let's say you're going from no value to value on the right, and from no growth to growth at the top. Okay, well, if you've got 4 quadrants, you can see that in the top right quadrant you've got growth and value. And in the bottom left quadrant, you've got no growth and no value. And in the bottom right quadrant, you've got value, but no growth. And in the top left quadrant, you've got growth, but no value. Now, what's the problem? The problem is that, as you saw, all companies have to get allocated. And so if you divide the quadrants like that, which is what happens, it means that value comprises a little bit of the growth and value, which is the quadrant you really want, and a little bit of the quadrant that you don't want, which is no growth and no value. And growth has a little bit of the no growth and no value, and a little bit of the growth and value. Okay, now that shouldn't really surprise you, because there's no free lunch. And if you're going to just invest in the index, well, not all those companies in the index are going to tick the box. So that's the first problem. all index constituents are allocated. If you're the S&P 500, all 500 have to go somewhere, and they're either growth or their value. But that means you'll have exposure to companies that are not growing and don't offer value, where your starting point is an index that's market cap weighted, okay, based on size, and where the largest companies are unlikely to offer the best value. And we'll come back to that in a sec. Okay, and so here's an example of a top 10 holding of one of the large value indices, and it's Procter & Gamble. And in the top half, you have the price of Procter & Gamble, and in the bottom half, you have the forward earnings ratio based on analyst estimates. Well, at the moment, Procter & Gamble, his forward estimate based on forward earnings is 25 times earnings, and the 20-year average PE multiple for Procter & Gamble is 15 times. Now, that means if you bought Procter & Gamble personally today and you paid out all the earnings to yourself as a dividend, and earnings were flat for the next, it would take you 25 years to get your money back. It's like investing at a 4% return. Okay, the problem is if Procter & Gamble just goes back to being rated in 15 times earnings, you've lost 40% of your money. But you might say, oh, but hang on, Sean, maybe it's growing fast. Well, this is what they said in their recent call. We're maintaining our outlook of core earnings per share in a range of inline, in other words, zero, it's just a nice way of saying 0%, to plus 4% versus the prior year. However, the steep increase in foreign exchange impacts pushes our current expectations towards the lower end of the range. In other words, close to zero growth. 25 times earnings for close to zero growth. Okay, but Procter & Gamble is not a unique example. Here's United Health. Now, you wanted to own United Health down the bottom here or anywhere along here. Do you want to own United Health up here? Well, if you do, you're buying it on 21 times earnings. And its 20-year average is 13 times earnings. And this is a top 10 holding of a value index. Okay, again, not massively attractive, I would argue. Now, price to book, as you saw, which was the common metric, is far from perfect. What is book value? Well, the book value of a company is the difference between the company's total assets and total liabilities. This is from Investopedia. So let's look at a couple of examples. This is the balance sheet of Boeing. And you can see down here, we've got total assets of 137 billion, and we've got total liabilities of 155. Let's look at the definition. It's the difference between those. Good. Okay. And that difference is 17 billion of net liabilities. Liabilities are greater than assets in the case of Boeing. So it's got negative book value. That is its book value. Okay. But what are in its assets? Well, in Boeing's assets, 79 or 80 billion of the 137 of total inventories is inventories, which are semi-assembled aircraft. That's what Boeing's book value largely comprises. Okay, let's look at another example, Carnival Cruise Liners. This is their balance sheet. And what do we have here? 8.4 billion of shareholders' equity, comprising 52 billion of assets and 43.5 billion of debt. Their assets are mainly property, plant, and equipment, not inventories as per Boeing. And so you've got 38 billion, and that's cruise ships. All right. And one other example is Salesforce. This is another company that's sitting in some of the value indexes. And what do we have here? 59 billion of book value, which is 92 billion of assets and 32 billion of liabilities. Well, do they have cruise ships? Do they have semi-assembled aircraft? No, most of their assets are goodwill, 56 billion. Good luck trying to sell goodwill. Okay, so that is how Salesforce's balance sheet, what Salesforce's balance sheet looks like. And so the point is, every company's book value differs. And so not all book value is created equally. Do you want semi-assembled aircraft? Do you want cash in the case of a bank, or loans in the case of a bank? Do you want cruise ships? Do you want goodwill? Right. So that's quite an important point. And so let's calculate. So that's book value. Now let's calculate price to book. How's that calculated? Well, for the entire business, you take the market cap, which is all the shares multiplied by the price, and you divide that by the shareholders' equity, which is book value, which we saw a second ago. Or you can look at it per share, which is one share's price divided by the book value attributable to each share. And so let's just work through an example here. Here's United Health Group, and this is from Google Finance. Its market cap's 489 billion. This is a top 10 holding in one of the value indices, 489 billion. What's its book value? 78 billion. What's its price to book? 489 divided by 78, and you get 6.3 times book value. Now, what is book value supposed to represent? It's supposed to represent what the company is worth if you shut up shop tomorrow. Okay, if you liquidated all your assets, sold all your assets, paid all your liabilities, what would shareholders be left with? And so anybody who's buying United Health is paying 6.3. Now, obviously, a business that is continuing to operate is worth more than liquidation value, but it gives you a rough sense as to what it is. The problem with United Health is it has nearly 95 billion in goodwill and other intangible assets. And so if you deduct that from goodwill, saying, well, I can't actually sell goodwill, you've got to calculate a tangible book value, something you can touch like a ship or a semi-finished aircraft. You've got price to tangible book value of 489 over minus, and you get a negative book value. So that's another problem that you have with this book value, is that in some companies, goodwill and intangibles comprise quite a large percentage of the book value, and the price to book doesn't differentiate between the two. Okay, now what is another problem? Well, the next problem is that rebalancing is usually only annually. So in the S&P styles methodology, this happens once a year in December. And for Russell, May is the ranking month and June is the transition month. And you can see that this year it took place after the close in June 24th. Now, what was quite interesting, given the timing of S&P and the fact that rebalancing is usually only annually, means there may not be value when you buy. If you are buying 11 months away from a rebalancing, what you're actually buying might change quite suddenly, and that's actually happened. So what's interesting here is this is the iShares S&P 500 Value ETF, which benchmarks itself to the S&P 500 Value Index. And you can see here, this is the end of November. We got Berkshire Hathaway, Johnson & Johnson, ExxonMobil, Procter & Gamble, Chevron, United Health, Merck, Coca-Cola, JP Morgan, and Walmart. Now, what's interesting is I looked at it as of yesterday, on the 16th, the latest published, okay? And what you can see, I thought, oh, goodness, I've got the wrong one here. You can see Microsoft, it's new. You can see Amazon, it's new on 85 times earnings. You can see Meta is new. No more Chevron, no more ExxonMobil in the top 10. You can see Cisco on 17 times and Nextera on 32 times. And of course, this comes back to the fact that rebalancing for this index took place in December. So you thought you were buying a fund full of oil companies and cheap companies, and now you find out that you've actually got a whole lot of money sitting in Amazon and maybe Microsoft. Now, what's interesting is Amazon entered at 2.73% and Microsoft 4.97%. Why are they so large? Because it's market cap weighted is the index that you started with. All right. So again, there may not be value when you buy. Now, the fourth problem that I think one wants to be aware of with these passive value ETFs and passive value indices is that the largest value indices / ETFs have more than 70% in US equities. Now, what we have here is the price of the S&P 500 Total Return Index. And you can see that that's gone from 120 years ago to 648. It's up 548%. Now, after this 20-year performance, do you really think that US equities are likely to offer you the best value in the entire world? Is this where you want to put 70% of your money now? Is the question I would have for you. Okay, so what about active value? Because aren't those the guys that the passive value, or passive funds always beating the active funds? Well, for some. So what we've got here is the value metrics for the world index for a number of different index providers. And you can see this is forward earnings multiple, mixing it up a bit. So it's 15.8. One of the value indices is 13.7, 15.4, 15.3. So call it 14, slight discount to the world index. Price to book 2.9, 2, 2.5, 2.4. Okay, dividend yield, you can see roughly 2%. So what's Ranmore's valuation metrics on the same basis? Well, our forward multiple for, if you look on a weighted average basis, is 6.8. On a price to book is 0.7. Our dividend yield is nearly 7%. Substantially better value than many of these value indices, we would argue. And the question is, well, how have you managed to achieve a portfolio of companies that are so much cheaper? By avoiding the problems that we've highlighted. We unsurprisingly don't have United Health, we don't have Procter & Gamble, we don't have Amazon, etc. Okay, but what about the fees? Because I want to invest in a value, passive value fund because I've heard that the fees are so much lower. Well, let's have a look. Performance is always in US dollars net of fees. And what we've got here, the blue line is the Randmore Global Equity Fund. And I tried to find an ETF, a world value ETF, and the oldest one I could find started back in 2014, which is quite interesting. You know, it just shows you how recent these products are. And so there was this huge gap. And so I had to go and start let's just compare apples with apples and have them start at the same date back in 2014. And you can see we have beaten this index or this ETF after our net of fees. But that's only since 2014. We've been going since 2008. So how have we done there? Well, we've got the value index. Remember, the other one was an ETF benchmarked against the value index. This is actually the underlying value index, and you can see this is from Morningstar Direct. Morningstar is a great source comparing apples with apples. I would highly recommend you familiarize yourself with it, and you can see that we have, excuse me, beaten the index over those periods 1, 3, 5, 10, and since inception. But how have you managed to do that? Net of fees. Well, let's go back to this quadrant. The reason we've been able to do this is because we focus on this quadrant, growth and value. And depending on how cheap it is, we're happy to tolerate no growth if it's really, really cheap. What we don't want is we don't want growth but no value. So no Microsoft, no United Health for us. Microsoft and United Health might be growing, but we don't think they offer value. And we definitely don't want no growth and no value. So Amazon, Procter & Gamble, and Meta are out the question. So if you've learned something about passives, about actives, please like, comment, and share. It's a way of saying thank you for us spending a little bit of time preparing this content and encourages us to do more. Do subscribe. We've got a few more pieces of content. We're busy using the quiet period between Christmas and New Year to put together for you. If you're interested in investing, get in touch. We are available on these platforms internationally and in South Africa. And I did mention that you should familiarize yourself with the notes and disclaimers. And here they are. But if you'd like a copy, please do ask us. And you'll also see them at the back of our fact sheet. Hope that's been helpful. And get in touch, and we'll look forward to seeing you next time.